Investors spend far too much time focusing on which company, sector, or geography to buy, trying to find the next big thing. Well, you're probably neglecting the most important decision you will ever make in terms of portfolio construction, and that is your asset allocation. If we were all robots and we didn't suffer from human emotion, we could create a portfolio that targets the highest expected return without any thought for volatility. However, the best portfolio is one you can stick with in good times and in bad. So let's analyze both the good times and the bad by looking at the US equity market, which is the largest equity market in the world. On average, this market declines by 10% once every year or so, by about 5% almost 5 times a year. Bear markets are defined as corrections of 20% or more, and we've seen 12 of these since 1950, with the average decline coming in at 34% and the worst of them coming in at 56%, which happened in 2008. Now, not only is it difficult to watch your hard-earned savings get cut in half, but it takes quite some time for the markets to recover. The average bear market recovery has taken 342 days to come back, a full year just to get back to break even, and that's the average. So, now that we've established the bad, let's get into the good. Historically speaking, equities have done an amazing job growing your money in excess of inflation over the long term. From 1990 to 2023, a globally diversified all-equity portfolio yielded an annual return of 8.1%. So not owning any equities shouldn't be an option for most. However, you can participate in equity market upside without signing up for full downside volatility. And to measure downside volatility, let's look at maximum drawdown. Maximum drawdown shows us how much the portfolio went down from top to bottom before it began recovering. And this theoretical all-equity portfolio that returned 8.1% a year, it also corrected by 40% in September of 2000 and took 67 months to come back. All right, we've covered a lot of numbers, so let's just summarize what we've learned. Equities do 2 things. They do a great job growing your money over the long term, and they also occasionally drop in value by a very large amount. To combat these drops in value, what if we created a portfolio that was 55% global equities and 45% fixed income? We now own 2 assets instead of 1, thus creating an asset mix. Fixed income is less volatile than equities and has a lower expected return as well, so it's going to change the portfolio outcome. This theoretical mixed portfolio averaged a 7.7% per year over the past 30 years instead of 8.1%. However, the maximum drawdown was 23% instead of 40%, demonstrating a much smoother ride along the way. And that's the trade-off. When you are creating an asset allocation, you must figure out what your ideal trade-off is. Maybe 70% in equities is ideal. Maybe 100% is still the way to go for you. Or perhaps you go all the way down to 35% equities. Your asset allocation should depend on 3 factors. First, the returns you need to accomplish your goals, and a simple financial plan can tell you this. Second, your time horizon, which determines your ability to absorb a market drawdown and wait for it to recover. And third, your psychological willingness and comfort level with volatility. When we begin a new relationship with a client, we spend time getting to know them, their family, their goals, and their comfort level with risk so that we can determine a suitable asset allocation. We want to build a portfolio that they can stick with over the long term, a solution that gives them the growth they need, but also allows them to sleep at night during a market downturn. During 2022, when the US stock market was down 25%, I had 0 clients panic sell out of their portfolio. One of the reasons for this, in my opinion, was that their portfolio had a healthy asset mix which protected them from full market downside. You don't typically want to make asset mix decisions when market drawdowns occur. You want to put in the work beforehand, because once it begins, it's usually too late.